Good afternoon, everyone. Uh, my name is Steve Burke. I'm with the Washington Small Business Development Centers. And today I'm going to talk to you about the concepts of the struggle that many of us are in, many small businesses are in, relative to being able to survive and get through this fairly rough period with the pandemic. We're going to talk about some essential overviews of turning around survival exit strategies in a time of business recovery. This is being recorded, and so I'll be able to answer questions while you're listening to me during this recording. If you can put them in the chat or the Q&A, whichever one shows up for you, and I'll be able to answer questions about this while you're actually listening to me give this presentation. So hopefully all of this works for you. I'm glad that you're here with us today on the afternoon of October 12th. And I'm looking forward to getting your questions and seeing if there's some ways that maybe we can relieve some of the stress that you might have relative to how your business may be doing, either planning to start a business coming out of this pandemic, or to survive or do something relative to the turning around your business during that time. So today we're going to cover, as I had mentioned, the business turnaround and pivot strategies, some steps to consider. One of the most essential things is controlling costs, managing funding and debt, which are all strategies to deal with, but things that you've got to think about. We're going to talk about business survival strategies, cash flow forecasting, and a tool that I use with clients all the time is margin management. Also want to talk about your exit options and strategies, including selling your business, closing down and leaving the business if necessary, and bankruptcy. We're only going to give you an overview of these things. I've got to preface this by saying that while Washington State's taken steps to get businesses reopened, I was able to attend a jazz show last night before I made this recording, and felt very safe. They did require vaccination status, and everybody had to wear a mask, but I still truly enjoyed myself. So steps are being taken to reopen, and even though the Delta variant is definitely providing additional challenges, the idea here of this presentation is to help you consider your options as you seek to recover or you plan additional steps. We've been working with many clients in different business situations over the last 2 recessions. I've been doing this for over 12 years, but it's important for you to know that I'm not an attorney, a CPA, real estate broker, an insurance professional. So I can't provide the kind of advice that you should seek from your licensed professional. This discussion, though, is for you if you're not really sure where to take your business or your business aspirations. And if you want to seek our assistance with your strategies and your business coming through, we work face-to-face, one-on-one, day in and day out with businesses at no cost to the business. And I'll show you at the end of this how you can contact us for that kind of help if you're interested. So some of the key steps in terms of turning your business around. One is, and I talk to clients about this a lot, they don't really believe that their business is as bad off as it is. Met with one recently trying to get a restaurant to recover, has put $450,000 into it just before COVID, and then got shut down, and now is in a situation where they are really hopeful that they can get a loan and get the money necessary to come out of it, but they aren't thinking about what that debt's going to do to their overall picture and the strategies that they need to employ regarding managing their cash flow so that they can come out with a sense of what's the truth about what's going on. So people cannot be in denial. And you've got to prove everything. I just mentioned having a detailed analysis of true situation and your future prospects. You have to act quickly and aggressively, cutting costs, right? Managing your money. People can be passionate and often are. In fact, passion is a key part of running a small business, having a belief in what it is that you're doing and the mission that you have and how you're making a difference for your customers or clients. But at the end of the day, it's always about the money. And if you aren't paying attention to it and you don't know how to either increase revenue or cut costs, particularly during recessionary times like what we're in today, you wind up in trouble. And so the idea of this presentation is to hopefully give you some thoughts about how you can realistically think about your opportunities. So, and then making a turnaround plan and follow with focus and determination, just as necessary, but don't lose concentration. This is a time to be truly focused, not to be fragmented, even though solutions may not be clear, data may not be clear, your strategies certainly may not be clear, but you've got to stay focused on it and move yourself forward through each and every step. So cutting costs. One of the things that I work with in clients day in and day out is a real understanding of their financials. I actually teach my clients a specific course on financial discipline, a real step-by-step ability to understand their financial reports, make sure that they're updated, stay in communication with the person who's doing their bookkeeping and accounting, and then review these on a weekly basis, 52 weeks a year without fail, so that they can really understand what these various elements matter and how they impact your business. So there's fixed costs and variable costs. Variable drops as gross revenue drops, but fixed is more difficult. Variable expenses include things like payroll, which is related to the sales of service and product, cost of goods, inventory, marketing and related expenses. You should be able to reduce these as your gross revenue and sales decreased, maybe during the pandemic. Maybe that's still the case, or maybe you're beginning to recover, and these expenses can go up essentially on a percentage basis as it relates to your gross revenue. But these do require, as I'd mentioned, focus and planning. Fixed expenses are harder. These include your lease and property costs, sometimes your utilities, insurance, and the big one is debt. All of these require some negotiating skills. You can make a difference in these. Through the pandemic, I've worked with quite a few clients who've been successful in working with their landlords and some who have not. Some landlords have dug their heels in and things, just meeting with a client today who's looks like they may be getting evicted from their commercial space and doesn't want to do that and wants to know if there's some way to prevent that. It's hard to do, especially when you're dealing with a commercial lease, which is one of my areas of background in my life, and have become really versed in the leasing and leasing issues. If any of you have got any questions like that and you want to reach out, feel free to do so. So funding and capital infusion is another area that a lot of people today are utilizing. Most of the SBA COVID pandemic relief funds have terminated or are no longer available. There's a slim chance that the Restaurant Revitalization Fund may get some additional funding from Congress, but it seems to me personally like that's becoming less likely day in and day out as Congress wrestles over whether or not to deal with debt ceilings and pass infrastructure bills and such. So I think that's less likely, but it's a possibility. But the two biggies that are available in Washington State right now, the first is something called the Economic Injury Disaster Loan, which is something that you should really look into. We can help you with that if you have thought about it but have not applied. We can also help you with that if you have applied, but it's being hung up for some reason. We've got a lot of resources relative to that. And then there's also a new thing in Washington State called the Flex Fund. So these are a couple of options. that are available to help people do the right thing if that's what it's going to take to make help their business be sure and survive. And we highly recommend, because both the EIDL and the Flex Fund are at interest rates and terms that you aren't going to find in traditional lending today. But for the EIDL as well as the Flex Fund, they still have to be underwritten. And so people do evaluate what I refer to as these 7 criteria to consider relative to borrowing money. The first is cash flow. They look at a global analysis from all current ventures and personal spending patterns. They figure out they did a determination called debt service coverage, which is one of those factors that they use from a mathematical perspective to determine the availability in cash, either historic or credible projections going forward, to determine whether or not you're going to actually have the money available to pay back a loan. And that's true for the economic injury disaster loan that is offered by the Small Business Administration, as well as the Flex Fund that's being offered by several community development financial institutions called CDFIs. So the second criteria that lenders look at in pretty much every case is collateral. Collateral is not required for the Flex Fund or the EIDL, which are 2 unique cases, but in normal traditional lending, it is, because if for some reason the loan fails, the business fails, there's a default, they want to be able to be made whole relative to the money that they lent. So they're looking at equity of 1 to 1.5 times the loan amount. As I had mentioned, collateral specifically is not required in either the EIDL loan or the Flex Fund, but the Flex Fund requires a personal guarantee, and the EIDL loan actually requires a personal guarantee if the amount is over $200,000. The other one is capacity, and this is really a big one. How much experience related to the businesses that the borrower have? 3 to 5 years is typically required. How much cash is being put into the borrower? How much risk is the borrower willing to accept relative to this borrowing money and obtaining funding? And by the way, this same 7 criteria that I'm going to go over is specifically related to lending from a traditional lender, but it's also relative to investors. This is the same kind of criteria that anybody who's going to provide a small business is going to evaluate. They want to know, are you putting up risk as well? Credit scores are real important. They are used for the EIDL and the Flex Fund and pretty much any borrowing that you do today. Personal credit scores as well as business credit scores. Almost always it's a personal credit score, but many times now they are utilizing separately calculated business credit scores. And then what I consider to be the most important one is this one on character. To what extent has the borrower, you as a small business owner, adopted the principles of a book called The E-Myth by Michael Gerber. This book is the most important critical book that we advise clients to read, that really talks about how to move from somebody working in the business to working on the business. And do they view themselves as the manager and creator of the business systems so that they really know what they're doing? Anytime you meet with somebody, a lender who maybe you are interested in seeing if you're eligible for a loan or an investor, this is the key thing that you're trying to evaluate. Do you have the desire to be a business person as much as you might have the desire and passion to do whatever it is your business is actually about? The last one's important too. Condition, what's the money going to be used for? For larger loan amounts, it's very common that the borrower never actually see the money, that it goes directly from the bank to the purchase of whatever it is that the loan is for, or a contractor that's going to be, that kind of work. So knowing what the money is going to be used for is a critical part in any lending situation. So supposing you went into this COVID recessionary period, difficult time with debt, and that managing that debt then has become a problem for you. Well, the biggest obstacle for many businesses in surviving a crisis is managing their debt. Strategies include cash flow forecasting, margin management, which I'm going to cover in a minute, controlling cash and looking for income, and as well as new sales opportunities. Can you increase revenue by looking at ways to pivot towards that? I had a client point out that when the pandemic started, they used the term, "Oh shoot, we have to pivot." Having a change mindset is what's needed. And I thought that was kind of cute, but I do think that it makes a point. Being able to think a little bit outside the box of what you were trying to do in your business, because there is a new normal. And in that new normal, there's changes in consumer spending and the way in which people are utilizing the money that they have. The increase in online work and the virtual world has definitely increased all of that. Other options include consumer credit counseling. There's an organization called CESI Debt Solutions, and then that I'll refer to a couple times. And then there's another one relative to exiting the business that we're going to talk about, and how do you get out. So, but let's cover managing the debt and managing your money. I usually teach a tool called margin management. And this is a tool that's based upon the percentage of your gross revenue. So let's just say that you're a really good manager of your business. And this is a general for a product-based business. It really can applied with different numbers to a service-based business just as much, and various different types of product-based businesses. But let's just say, here's a case where you're running a restaurant. And the restaurant produces a product, the food and beverage that's sold and served to its customers. So let's just say that you're a really, really good manager. And as a percent of the gross revenue, cost of goods sold, say, is 30%. Payroll is 15%. Your lease, maybe did a great job on negotiating that. It's at 8%. And then all other utilities, marketing, insurance, et cetera, is at 10%. So you add those up and you get 63%. And that means that you've got 37% left for you in debt. Most businesses that I work with are somewhere in between this good and bad category. But if you look at the bad side and you are somebody, or a business, or a business that's just taken their eye off the ball, or maybe through the pandemic here and trying to get things to work, they didn't realize how bad it had gotten relative to their cost of goods sold. And it had grown to a percentage of their gross revenue of 50%, which I've had clients that have had exactly that happen. They've discovered that to get people to come back to work, they've had to pay them more. Payroll has increased to 25%. I read a story a couple days ago about a restaurant in Los Angeles that has increased its hourly rate to all of its restaurant employees of $25 an hour or more, and no longer requiring customers to provide a tip. In fact, they won't take them. So different strategies to employ here, but still, if you take a look at the overall margin and you've done a poor job of handling payroll, it's grown to 25%. Your lease, frequently, the restaurant that I talked to yesterday, the lease was running 30% of its gross revenue. One of the things that we know about a lease, this is the one cost in this whole area that once you've signed that lease document, it's very hard to negotiate with a landlord, although many were pretty good during the pandemic, but that's changing back now. If a product-based business, the lease is at 10%, they're probably just making it, although the owner may not be taking home a lot of money. And if at 15%, it gets to 15%, they're actually on the verge of being in serious trouble. All other costs like utilities, marketing, insurance, maybe, took the ball off and costs increased maybe during the pandemic to 20%. You add all these up and you're 115%, which is meaning that the owner is providing 15% injection back into the business to be able to keep it alive. So how do you calculate this? How do you actually keep track of this? Well, one of the tools that we utilize for this is something called cash flow forecasting, where you track actual cash, real cash. As I mentioned up here, it's projected up here in the upper right, projected cash flow. And you've got the beginning cash, that's the actual money that's in the bank here at the beginning in this month one. Say it's 13,283. And then you've got the various income, product, service, others. Maybe you resold something, or maybe you've got some other type of regular income that comes in. So you've got total cash from operations. Then you have other cash in. Keep in mind that this income portion right here that's in the kind of the colored box is on the profit and loss sheet. The other cash in is on the balance sheet. So I'm pointing out here that you've got cash portions of the profit and loss and cash portions of the balance sheet. Neither of those reports covers cash just by themselves. And we'll talk in a couple ways here in a second about why. Well, let's just say the other cash in is money that you put in, money you get from a loan, or other income. If you are one who is maybe getting that other income here, might have been selling some real equipment that's of value. That would mean that you sold an asset on the balance sheet, and that's where this cash would come in. So then you've got the other total cash in, and then this total cash income for the month covers the total cash in from our operations and the total other cash in. This page is a little bit hard to see, but it covers all the various expense items that are cash out that occur on the profit and loss sheet. So this is just the profit and loss, normal expenses such as advertising and marketing, auto, bad debt, bank charges, commissions, contributions, cost of goods sold labor. Cost of goods sold labor is that labor that's directly related to the sale of the product or service. If it is administrative, then it comes down here, the second from the bottom, called wages. So you've got to separate those two to understand them. Cost of goods sold other is not the products that you are purchasing for resale. If you consider everything that you buy for resale to be cost of goods sold, even though it's not yet sold, you do not have any mathematical way to track inventory and inventory shrinkage. The only way that you can do that is if you post the inventory on your balance sheet, and I'll show you that in a minute, and instead of calling it cost of goods sold, but you move it from the asset on the balance sheet to true cost of goods sold as a non-cash item on the profit and loss, but only when it is sold. So anyway, dues and subscriptions, insurance, auto, business, the interest portion of a term loan. The principal portion is paying down the liability on the balance sheet. The interest portion is an expense on the profit and loss. So you've got these other categories: merchant meals, merchant fees, office expense, postage and printing, professional fees, rent, repairs, maintenances, taxes, telephone, travel, utility, administrative wages, like I referred to, and then maybe miscellaneous. These are all items that are on the profit and loss. On the balance sheet, you now have other cash out. So you've got the term loan payments, maybe principal, line of credit payments. The inventory purchases go here. They don't move to the profit and loss until they're actually sold. In equipment purchases, vehicle purchases, now you previously had at the bottom of this page the total expenses. Now you have got the total other cash out, and the two of those together gives you the total cash out for the month. Then from this slide where you have the total cash income from the month, you then go to the total cash outflow and you calculate the ending cash position, which is the difference between those. And if you've done well, you've got a positive number here. It looks like it's 11,000 something. And then you take the beginning bank balance that you had way up here at the top in the beginning of each month, and you subtract from that the ending cash position for the months, which then gives you the ending bank balance. And so that's how you calculate this. And the idea is not to put in what actually happened in each of these columns on a spreadsheet, but to put in what you think is going to happen. So then at the bottom down here, when you get to the ending bank balance, that's really the money that's left over for the owner, and is essentially the extra profit, if you will, or excess cash in a business. The true excess cash doesn't actually qualify as profit from an accounting perspective, but it is the excess cash, and it's the money that's available for the owner to use for whatever he or she would like. So the idea is to have that dollar amount grow as you see it's doing on this particular spreadsheet that I'm showing you at the moment. So the idea here is that that ending bank balance. If these are your projections, not your actuals, but your projections going forward 12 or 24 months, then one of the things that you're going to discover is that when you get to the end of every month, it's not what you thought it was going to be. You know, in this model here would never wind up actually being 11,134. So then your job is to determine why it's not what you thought it was going to be and what you projected it to be. And you use the difference, you find out sleuth why, and you use that difference to determine what's going to happen, how you're going to change the numbers on your spreadsheet going forward. So that's the cash flow, managing money. These are all tools I'm really just giving you an initial exposure to. You may be good at this already, but I want to expose each of these items to you, because if you were to meet with me and we were to start talking about this kind of stuff, this is what we'd be doing, and we'd be digging into this to a greater extent. So I'm trying to give you an exposure to these things today so that you can be much better at predicting what your financial future is going to be. Doing cash flow forecasting and updating it at least once a month is absolutely critical to any business, especially if you think you're going to have a chance to survive the pandemic. If you really don't know what your money is doing, your odds of failure are extremely high. Well, we don't want to talk about it that much, but supposing you have decided that you're tired, I've talked to several clients that I've had over the years who really just got worn out as a result of COVID and this pandemic, and they're ready to find a way out. Well, in selling your business, which is one of those exit strategies, one of the things that we are learning over and over again as we talk about business valuation is that the price that you want has nothing to do with what people will pay. And so being realistic about that is extremely important. And there's several tools available in terms of calculating business valuation that you can get assistance with to help determine what your business is if you're trying to get out. But unrealized potential of the business, being able to say that as soon as the pandemic is really over and everything can return to normal, this business is just going to take off, so you ought to pay a lot of money for it. That just doesn't work. If you're the main value in the business and your business is not, then it's not worth much. This is really an evaluation of, did you work in your business or did you work on your business? Did you create systems so that you didn't have to be there all the time? And did you then tweak and manage those systems? Or were you required to be working in the business every single day because your management skills just were not that well established? If that's the case, there's a real probability that your business isn't worth very much. Maybe the value of discounted value of equipment and inventory is often about all there is. And the reason is that the business was solely dependent upon you. And if you sell it, then you're not there to work in the business. And therefore, people buying it are like, well, that's not the way I want to do it. So we find that it's just not worth that much. We do recommend that you don't start the sales process if you're not prepared. Engage a broker. I'm going to talk to you about readiness here next. but 67% of all businesses were founded by their owners. 22% purchased their businesses. So what that means is that in reality, more people are starting a business than buying one. A few were gifted or inherited this. This is directly from the SBA Office of Advocacy, something that I get reports on a regular basis. 64.5% plan to sell their business, but that can be really difficult. Plan to sell their business someday, although that has really gone up here through this most particular pandemic recession. But this is going to be difficult if 2/3 start their businesses and don't want to buy it. They all think that they can start from scratch and do it their own way better. Well, if that's the case, it just reduces the number of buyers. So you've got to make it much more appealing to somebody who might actually be interested in buying it. So there's an organization called the Exit Planning Institute, EPI. They report that 76% of owners want to transition out of their business in the next 10 years. 49% of those don't even have a transition plan, don't really know what they're going to do. They're really just focused on running their business until they do want out. 70% or more of those businesses put on the market don't sell, meaning that the owner wants too much for it, the business isn't well run, or there's some other category that minimizes its saleability. 30% of family-owned businesses transition to the second generation. Only 12 survive to the third generation. Passing it on to your kids can be really problematic in the long run. These statistics are pretty accurate. 81% of all U.S. businesses have no employees. That's also from the SBA Office of Advocacy. So that means that, for a business of value that's not dependent upon the owner, is, probably less than 20% that really have the ability to go forward and be successful in selling their business at some level. So closing the business, this can be tricky, but it's the option that you might take if your business is not sellable, and bankruptcy, which we'll talk about in a minute, is not viable. This is known as liquidation or dissolution. It's the process in accounting by which a business is brought to an end for different reasons and by different processes. The assets and the property of the company are sold or transferred. Sole proprietors can decide this on their own, but any type of partnership requires all of the owners to agree. To do this, you have to file the articles of your organization, such as the operating agreement of your LLC or the shareholder documents and bylaws that you might have created when you did a corporation. But you have to file dissolution documents. Failure to legally dissolve an LLC or corporation with any state you're registered in will expose you to continued taxes and filing requirements. So you've got to pay attention to that. You need to cancel registration, permits, licenses, business names. Protect your finances and reputation by canceling any of these that you no longer need, including your trade name. Closing the business process. You have to comply with employment and labor laws. You've got to reference the Worker Adjustment and Retraining Act, Notification Act for employee payments, along with other federal and state laws. Resolve financial obligations, file tax returns, complete your state excise tax return, either get or obtain the money to do this, which is one of the things that causes people to not close their business when they should, because it's kind of like having a divorce. In reality, it sometimes costs more money to do that than it was worth, and you might have been able to resolve the issues if you'd gone through it very carefully, and maybe even followed some of the other topics that we were referring to earlier today. Cancel your employee identification number, notify federal and state taxing agencies. And you got to maintain records. You may be legally required to maintain tax and employment record, among other files. Common guidelines advise keeping these from anywhere from 3 to 7 years, depending upon what they are. All right, now we're going to move into the bankruptcy sector of this. we're going to talk about Chapter 11. There's a new thing now called Subchapter 5, but bankruptcy, Chapter 11, is called business reorganization. Essentially, you have to hire an attorney. An individual cannot go through this process on their own. The courts really don't want to have to deal with people who don't understand the bankruptcy law. So, and it's important to note that this can be expensive, and it's, for most people, it's not really an option. If you aren't able to find the money to finance your business and keep it going, and you're not able to close it down or sell it, then you've got to figure that it's going to cost you several $1,000s and 1 to 2 years to go through a bankruptcy, any one of these bankruptcy processes. Then the debtor must file with the court schedule of assets and liabilities, current income and expenditures, executory contracts and unexpired leases, and a statement of financial affairs. On filing the petition, the debtor automatically assumes an additional identity as the debtor in possession. Then a plan of reorganization must be filed with the court. Debt payments are stopped and workout plans are started with every creditor. As I'd mentioned, Subchapter 5 is a newer version of Chapter 11, and it's for small businesses. They've figured out that small businesses, like many of the businesses attending the small BizFair, this category works better for it. So it reduces some of the complexity, lowers some of the cost, and it can, in some cases, allow the owner to maintain an ownership business in the interest, ownership interest in the business following the conclusion of the Chapter 11 reorganization. Chapter 13 is personal bankruptcy. You'll need an attorney to do this as well. I've worked with several clients and actually met with a few who met with a personal bankruptcy attorney in downtown Seattle. And they asked for $250 in cash to be handed literally across the table. And they gave them exactly 60 minutes to talk to them about whether or not personal bankruptcy is a good idea given their circumstance and situation, what the process would be. And then if the attorney agrees to take you on, they will start, invoicing for additional costs as you go through the process. Again, this can also be a pricey proposition, but the idea is that you're trying to determine what level of assets you get to retain as a result of going through this personal bankruptcy. It does enable people and business owners with regular income to develop a plan to repay all or part of those debts. You have to propose a repayment plan and to make installments to creditors over 3 to 5 years. And it offers individuals an opportunity to save their homes, as I was just alluding to, from foreclosure, but depending upon the value. If the allowed value to prevent losing your home is $300,000, but your home is worth $1 million, you may still be in trouble. It does allow individuals to reschedule secured debts other than a mortgage for their primary resident and extend them over the life of the Chapter 13 plan. And then you make plan payments to a Chapter 13 trustee who then distributes the payments to those creditors. Chapter 7 is the last resort, the last case. It literally is asset liquidation. You would only use this if Chapters 11 and 13 or other options are not viable. You'd still need an attorney. To qualify, the debtor may be an individual, a partnership, a corporation, or other business entity. And it does not involve the filing of a plan of repayment, because what happens is the bankruptcy trustee gathers and sells all of the non-exempt assets and uses the proceeds of those assets to pay the holders of the claims. Individuals must file a certificate of credit counseling, like SESI that I referred to a few slides back. And there are many other credit counseling agencies out there, and a copy of a debt repayment plan developed through credit counseling, evidence of a payment from employers, a statement of monthly net income, and anticipated changes in income and expenses. Well, we're almost through here, and we'll get to any more questions that you've got at the end of this. But here's some things to remember. I really advise people to avoid what I refer to as an analogy, as a tale, if you will, and that's avoiding white coat syndrome. White coat syndrome is that thing that kind of happens to about 95% of all patients of doctors who go to a doctor, and the doctor says, you've got this ailment. I need you to take this prescription and come back and see me in 30 days. What percentage of people do that without asking any of the key questions, like what is this prescription for? How long is it going to last? What does it cost? What are the side effects? What happens if it doesn't work? And on and on. 95%. And I've got 6 doctors who are clients, and I ask them because I'm curious, what percentage? And they've consistently told me less than 5% ever ask any of those questions. They just take the prescription and then report back in the month or whatever time period they were given. But at the end of the day, who's in charge of your health? Only you. Very difficult to sue a doctor because they gave you the wrong prescription. Very, very difficult, if not even impossible, and certainly cost prohibitive. But the same thing is true with your business. At the end of the day, you are the only ones who are in charge of your business, not someone else. You're the final decider, not your attorney, not your CPA, not your business broker, not your business advisor, not your insurance broker, not your real estate broker. You're the only one at the end of the day who has to make the decisions. That's why the number one trait for success, long-term success of a small business is having the desire to have at least as much fun, if not more, of learning, practicing, and refining that separate set of business skills over the skills that are necessary to run the business. So avoid white coat syndrome relative to running your business. Don't put that white coat on anybody but yourself, and make sure that you know and study whether or not the decisions that you're making. I talked to a client just a couple of days ago who said, yeah, I'm learning a lot from my mistakes. And I think my response was, well, I'm glad you are, but you're running out of mistakes to have. It's about time to actually learn the business skills so that you don't have to be making so many mistakes that are winding up being costly. So those who desire to be good business people, at least as much as what the business is about, have better survival opportunities and odds. As I say, a person without a plan always gets managed by others who have one. Make a plan. Do not be a victim. And a business failure does not mean that you are a failure. By the way, when you work with somebody like myself, and there's also great people who are SBA resource partners like SCORE, Veterans Business Outreach Centers, Women's Business Centers, and us here at the SBDC, we all offer advising services at no cost to the client most of the time. And for the SBDC, we have now 26 separate locations around the state and 36, soon to be 37 business advisors. And we're also aligned with all of these organizations that you see on the right here. One of the key things I say about reaching out to one of us business advisors or SBA resource partners is that we are the only ones that you can work with who have no financial interest in your business, so that we can be considerably more objective with you and your business strategies than anybody else, including an attorney or a CPA. While we may not provide that level of professional advice, and you do need to have attorneys and CPAs, it's still important to note that business advisors that are at no cost to you, the client, have no financial interest in your business and can make and assist you with making considerably more objective decisions. So one of the best ways to reach out to us is at washington@wsbdc.org or 833-492-7232. And with that, I will move on to questions that you might have.